Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the state of the AI ecosystem and the radical industrialization of big tech. Because what started as a purely digital software boom is running headlong into a very hard, very real physical wall.
That's it, exactly. That is the core conflict driving the market today. The AI sector is now defined by really a violent collision between these infinite ambitions in software and capital and the hard finite realities of, energy grids and physical infrastructure. And because of this collision, big tech is quickly morphing into these capital-intensive industrial entities. And they're facing a structural 19-gigawatt power deficit and a looming $293 billion depreciation time bomb.
Okay, let's unpack that. When you hear numbers like that, you immediately recognize that this isn't just a story about code and algorithms anymore. We are witnessing a fundamental structural transformation. For years, the appeal of big tech was its fantastic margins, right? High growth, zero marginal costs for copying software, minimal physical capital. Now, you're telling us the software industry is turning into a heavy industry. What does that industrialization actually look like on the balance sheet? And why should you, the investor, care about the difference between a software company and, say, a utility?
You should care because this changes the entire risk profile. We call the massive spending the Capex explosion. These companies, we refer to them as hyperscalers, the giants like Google, Amazon, Meta. They're spending just vast amounts of capital expenditure to avoid the single greatest threat in AI, which is irrelevance. If you don't have the compute, you simply don't have a seat at the table.
So the price of admission to the AI race is just becoming exorbitant. We've gone from millions to hundreds of billions.
Absolutely. The numbers, they really illustrate this shift in DNA. This is no longer high-margin software behavior. Look at the spending relative to revenue. You've got companies like Oracle spending, $56, and Meta is spending $45 for every $100 in revenue they bring in. That is factory business behavior. That's not software behavior.
And when you zoom out and look at the actual dollar figures, the scale of this physical commitment is just staggering.
It is. AWS, which is Amazon's cloud arm, is tracking capital expenditure near $125 billion for the fiscal year 2025. And at the same time, Google's Capex is projected to be in the range of, $91 to $93 billion for 2025. And their management has already signaled that number is only going to rise further in 2026. This isn't just about ordering a few 100,000 GPUs. It's about pouring concrete, laying massive fiber lines, building global industrial-scale infrastructure.
But unlike pure software, physical infrastructure comes with a brutal accounting reality. Obsolescence. And this is where the financial peril truly kicks in, what the sources are calling the depreciation time bomb.
Exactly. This is the risk big tech never really faced before. If Google, retired an old piece of software, it was a minor footnote. Now they are deploying data centers filled with specialized AI chips. And traditionally, accounting models depreciate these assets over maybe 5 to 7 years. But if a new chip, let's say NVIDIA's Blackwell, makes everything you bought 18 months ago essentially useless, well, that depreciation schedule just collapses. You still have the $10 billion cost on your books, but the useful life just disappeared.
So instead of slowly writing off the cost, you have to just hit the write-down button, which then crushes your income statement.
That's the difference. Depreciation is the slow, scheduled expense. A write-down is the sudden, catastrophic acknowledgement of that value loss. And the sources are projecting a potential aggregate bill of $293 billion by 2027 in accelerated depreciation and, potential write-downs across all the hyperscalers. That is a massive amount of capital that could simply vaporize if the pace of AI innovation outruns the pace of accounting. And we don't even have to wait for 2027 to see the pressure. Google's depreciation expense has already climbed by 41%, putting real stress on their operating margins right now. This is a very real, immediate financial friction caused by this shift.
And that structural friction, it doesn't just pay on the balance sheet, it hits the actual physical world. So if the Capex explosion is one constraint, the other is what it takes to power all that capital energy. We hit the physical wall.
And that wall is made of kilowatts. The ambition of AI is infinite, but the physics of data centers are, finite. This is creating what we call the gigawatt gap. Our sources indicate the industry plans to deploy about 44 gigawatts of new AI infrastructure globally. That's the demand driven by all the chip purchases.
44 gigawatts, that is an enormous amount of energy. Just to give you some context, that's roughly the output of 44 large nuclear power plants.
Precisely. And now, here's the reality check. Current near-term power projections show only 25 gigawatts of power capacity ready to support that build-out. That leaves a quantifiable structural 19-gigawatt deficit that must be bridged. We have the chips, we just can't plug them all in. Building the grid takes years, not months.
And this is where it gets really interesting, because this isn't just some abstract national problem. This is landing with shocking severity in local communities. The Louisiana case study provides a perfect and frankly startling microcosm of this conflict.
It really does. The Louisiana case highlights the stark trade-off communities are being forced to make between corporate scale and local resource strain. Meta's $10 billion Project Hyperion data center is a huge capital investment, no question. But once it's operational, that single project is projected to consume 20% of the state's total energy supply.
20% of an entire state's power grid for one facility. I'd read that detail several times. So what's the return to the local economy that justifies diverting a fifth of the state's energy capacity?
Well, the massive investment is offset by a massive subsidy, $3.3 billion in state tax breaks. And yet the facility only generates between 300 to 500 permanent jobs. And this demonstrates the core conflict. You have an enormous subsidized corporate investment that fundamentally alters the local energy landscape for a minimal number of lasting jobs. It forces local communities to weigh the shiny promise of high tech against the practical reality of resource impact. This physical friction is the first major break on that infinite ambition.
Right. That sets a very difficult stage for the infrastructure players. So if the foundation, the hardware and energy, is becoming this intensely capital-intensive and scarce, let's talk about where the dollar actually settles. Who is capturing value from all this immense spending? Our sources break the AI ecosystem down into an investment pyramid.
Exactly. At the bottom, you have infrastructure, the chips, the servers, the energy. In the middle are the foundational models, the large language models like GPT, Claude, or Gemini. And then right at the top, you have the vertical applications, or as they're often called, wrappers, the consumer-facing apps built on top of the models.
So where are the immediate winners right now?
The value is definitely accruing to the layers with the strongest barriers, and those are often rooted in physical or data moats. So on the physical side, that's infrastructure suppliers, places like Taiwan, obviously, due to their advanced manufacturing, and key memory producers like Micron, who are seeing significant DRAM price increases simply because hardware demand is insatiable.
And on the software side, it's the companies that control the flow and quality of mission-critical data, which makes them resilient to the constant changes in the models themselves.
Absolutely. The biggest software winners are those with data refinement capabilities and strong enterprise moats, meaning it's expensive or difficult for a customer to leave. Palantir is a significant example here, leading with 141% YTD performance, and they're achieving an exceptional level of financial efficiency. They're hitting a rule of 4 of 114% in Q3 2025.
The rule of 4, that's a great metric for you to know. It's when a company's revenue growth rate plus its profit margin percentage equals 40%. Palantir hitting 114% tells you they are growing and profitable at a remarkable clip. They're hitting the accelerator while maintaining a level of financial discipline most high-growth tech firms can only dream of.
And that's the power of the data moat. Other key players leveraging similar advantages include Snowflake, which serves as the neutral data backbone for the enterprise, and Datadog, which acts as the observability layer. They win because they are systems of record or manage the critical flow of that business data.
Okay, so contrast that robust foundation with the top of the pyramid, the wrapper layer, which our sources flag as being far more fragile and full of potential losers.
The issue at the top is the complete lack of a sustainable moat. Vertical applications are just so vulnerable because the foundational models, the core intelligence, are constantly internalizing their features. Think of it this way. What used to be a paid, specialized app feature yesterday, Google or Anthropic, just gives you for free in their chat box today. When the API layer underneath provides no differentiation and the software layer on top can be copied effortlessly, rapid convergence is inevitable. The large AI labs just absorb the functionality.
And we have a concrete, almost shocking example of just how fragile that top layer is.
We do. Look at Perplexity AI. Its app downloads dropped by a staggering 80% in a single month, right after pausing paid marketing. That massive decline just proves the fragility of these application layers when big AI labs copy their functionality and the product isn't materially different from what the foundational model can already do. Venture capital may be flowing there because of FOMO, but those investments are stuck in companies that lack the long-term structure for value capture.
So the foundation and the deep data layers are robust, but the flashy consumer end is a house of cards. This brings us to the broader market sentiment and the indicators that we may be heading toward a bubble, especially considering the returns needed to justify all that physical infrastructure.
And this is where we examine the profitability gap. The investment projections are enormous. Hyperscalers are projected to hold an incredible $2.5 trillion in AI assets by 2030. Now, to achieve just a break-even return on that massive capital investment, they must generate an aggregated $750 billion in additional operating profit.
Additional profit, that's insane.
Yeah. It is. Their current total operating income is only around $450 billion across the cohort. They would need to nearly triple that total operating income in the next 5 to 6 years just to break even on the capital they are deploying. That is an enormous financial hurdle, and frankly, a highly speculative bet on future monetization.
That profitability gap feels like the definition of overextension, even for the biggest players. And leaders in this space seem to recognize this tension publicly.
They do. Sundar Pichai made a public admission that the market contains elements of irrationality. This signals that the structural conditions for a bubble, namely high demand meeting lightning-fast diffusion, are definitively present. Companies can't stop building because competitive pressures force them to address supply constraints until there is massive overcapacity. They have to build until prices collapse.
Which brings us to our final synthesis. If we put this whole picture together, the massive spending, the looming depreciation risk, the energy deficit, the profitability gap, how should we understand this investment wave? I love the physical analogy our sources provide to simplify the entire story.
It's the supersonic train. The industry is currently buying trains, that's the AI chips and Capex, much faster than it is laying tracks, which is the energy grid and physical capacity. The trains are incredible, technologically transformative, but they can't run indefinitely or globally without the supporting physical infrastructure.
And that leads directly to the two major execution hurdles that threaten the entire return on investment. The first is what happens if AI succeeds too well?
Exactly. Hurdle number one. Collapsing intelligence costs. If AI truly fulfills its promise and permeates every aspect of our lives, two things must happen. Foundational models must be commoditized and infrastructure must be overbuilt. We saw this exact dynamic with the internet. Wholesale internet transit prices collapsed from the late 1990s through 2015. Once AI becomes a fungible commodity, the high returns on investment for the hyperscalers vanish, and they start to operate much closer to low-margin utilities. Their entire financial model depends on keeping intelligence expensive.
So success creates the conditions for financial failure in the infrastructure layer. And the second hurdle is that physical wall we discussed earlier, the community resistance to becoming the dumping ground for the utility aspect of AI.
Which is hurdle number two, community resistance and physical reality. The corporate hubris involved in planning these massive, subsidized scales of investment often clashes with the practical realities of community pushback on resource strain. We saw it in the fight over tax breaks and energy consumption in Louisiana. This physical friction, the fight over land, water, and power, will act as a major real-world brake on the infinite ambition of big tech, causing delays, cost overruns, and canceled projects.
So we have a clear path of technological inevitability, but it's coupled with a structural path toward overcapacity and diminishing returns. The core question for you to mull over is this. How should a well-informed investor weigh the inevitability of the AI transformation against the inevitable structural bubbles it creates in both the application and infrastructure layers? The conflict is stark. Infinite digital ambition meeting finite physical reality.
Risk defined, portfolio protected.